Hello and welcome to my channel. My name is Tom and I will be presenting to you today Unit 1.2 Types of Organizations in Business IB Management. Now the content for this video will be I'll be talking about public and private sector, the types of for-profit organizations, the four different types, and the advantages and disadvantages of these four types of organizations. So first, public versus private sector. This is a pretty important key factor you should always know. Private sector means or refers to the business that is run by a private individual and it's usually looks to make profit. Like one of their main objectives is usually to make profits, not always, usually. For example, Apple or Tesla. And the public sector, those are organizations that are run by the state or the government, usually with a social objective, such as a police force, which is trying to keep law and order in the country, or the metro slash subway in New York, that tries to give people of New York an opportunity to get cheaply from place to place in city. Now, how to remember this? I always tell myself that when you think of public sector, um, the objective of a public sector company should be something for the people. That's why public. It's for everyone. It should be for everyone. And that's how I always make the connection. Public is state run for the people. Now, two other key concepts and terms in the public and private sector terminology is, for one's privatization, which is pretty much the process of turning a public sector company into a private one. That can be from a buyout or just some sort of deal. And that's also been the trend in the past years to do that with companies. So that might also come up in exams. And also nationalization, which is the exact opposite, turning a private sector company into a public one. Now, really fast, types of for-profit organizations. So the first and easiest for-profit organization is a sole trader, which is basically just a private individual, one private individual who runs his business and keeps all the profits for himself pretty much. But that also means that he also carries all the liability. The business is pretty much him. It's not a separate legal entity. Then partnerships is about the same. It's just now with a partner or with more than, it's basically the same as a sole trader, just with more than one individual. And I believe in the US it can be up to 20 individual a partnership. And it has the same like I said before, it's the same as a sole trader. It carries all the liabilities and they probably share their profits with each other. Then to the limited companies, there are two types in the limited companies, but just to be clear, a limited company is a company that has limited liability for the people that are working there or that own the company. Actually, that own the company. Because in this case, the company is a separate legal entity, completely detached from the individual who founded, for example, the company. And there are two types. One, there's a private limited company where they have less rules and they are still pretty private. The shares of the company, the ownership is pretty private, and you cannot just purchase the shares off of public security markets. And then the public limited company, that's the companies where you can buy the shares in the stock market. And that's why the public, because you can buy them, pretty much everyone in the public can buy a share of that company. And then the last one is basically cooperatives, which I will be going much deeper into part two of unit 1.2, the video. Now, the advantages of a sole trader or benefits, there are lots, but the simplest ones are it's easy to set up. There are really no legal formalities. Also, the second benefit is that the owner has complete control. He doesn't have to answer to anyone. He can make all the decisions. And that's why also the owner keeps all the profits, which can be a really big benefit when you think about it. When there are so many people involved in these other companies, the profit that is left for the actual owners is not that much because they have to share it with all of the owners. But in this case, the owner keeps all of the profits. That's also, again, the fourth benefit is he or she is able to choose times and patterns of working. That's also to do with that the owner has complete control. And another one that the IB listed here is that they are able to establish a close personal relationship with staff and with the customer. So it's more personal, a sole trader business. If you go buy a product of a sole trader, you'll feel more the connection. And the last one is that the business can be based on the interests or skills of the owner, rather than working as an employee for a larger firm. And it's really all basically connected to the point of the owner has complete control and he doesn't have to answer to anyone. He can decide what he wants to do with the company, which is a pretty big benefit. Now to the disadvantages of a sole trader. It's like we said before, unlimited liability. All of the owner's assets are potentially at risk. If he does make losses, then he'll have to pay for them. Also, he often faces intense competition from bigger firms because sole traders, they tend to be smaller. And for example, if a small sole trader or entrepreneur has a food business, like a food restaurant, and then there's all these other food restaurants next to it with these big brand names, it can be really intimidating and big competition for the sole trader. Another disadvantage would be that the owner is unable to specialize in the areas of the business that are most interesting, that he or she is most interested in, and because he or she is responsible for all aspects of management. And that's to do with the fact that he does control all the business, so he has to decide and look at every part of the business, which might be tiresome for some business owners. Also, it's more difficult to raise additional capital, as sole trader is not really looked at as a stable option for giving capital. For example, banks would rather give capital to a public limited company, a separate legal entity. The last one that the IB lists is that it also often requires long hours to make the business work, pretty much. Oh, and then another one is also, and this is mentioned pretty often in the IB, it's a lack of continuity. I'm sorry for that. I cannot really pronounce it, but you can see how it's written here, or how it's spelled out. And it pretty much means that because the business doesn't have a separate legal status from the owner, when the owner dies, the business will unfortunately die too. Then the partnership benefits are that the partners may specialize in different areas of business management. So they have, for example, each partner is specialized in maybe a function, or like it says here, specific area of the business, which makes it there's more expertise to each area, which might make the business better. Shared decision making might bring in new ideas and other perspectives, which is better for a business. IB really likes that. Also, additional capital is injected by each partner. Funds of more than one people is of course more than just fund of one individual, in most cases, of course. Um, the losses at the end are also shared between partners, so the liability might be a bit less if you think about it. Also, that's a benefit against these separate legal, like this limited company thing. A partnership has greater privacy and fewer legal formalities than corporate organizations. And corporate organizations are these limited companies. And we'll dive deeper into that later. Now, disadvantages to partnerships is that there's still unlimited liability for all partners. There are some exceptions, but in the IB, we do say that we do generalize it and say that there's unlimited liability for all partners. The profits are shared, which means there's of course there's not just one owner who keeps all the profit like in a sole trader. It's shared now, which is a pretty big disadvantage in business. And the same as in sole traders, there's no continuity, and the partnership will have to be reformed in the event of the death of one of the partners. Also, all partners are bound by the decisions of any one of them, which also can at the end create conflicts between them and take time, and which is also not good for the whole business environment. And it's also same as the sole trader, not really possible to raise capital. Oh, yeah, it's not possible to raise capital from selling shares, such as in limited companies. Also, a sole trader taking on partners will lose independence of decision making. That's to do with that everyone now has a say in the business. You cannot just choose what you want. You have to listen to the other partners and decide with them. Now, private limited company. The benefits of a private limited company is that the shareholders have a limited liability, and that's a pretty big one because you never really know what's going to happen to a business for 100%. And if it does go wrong for some reason, it might be government rules, it might be something external, might be something internal, whatever it is. The owner, because it is a separate legal entity, the owner has limited liability, so he won't have to pay all the law. He won't have to pay the loss with his own, basically with his own net worth. He won't have to give up his house, which is a pretty big benefit. Of course, that's to do with a separate legal personality. Also, in this case, there is continuity in the event of the death of a shareholder because it kind of has like an own ID, you could say, the company. It's a different person. So in this case, the company wouldn't die. If the person dies or the shareholder, the only problem there is where the shares go, and that's pretty much, well, they go to whoever is in the family of the one who just died. And another benefit is that the original owner is still often able to retain control. Why is that? This is because in a private limited company, when you convert to a private limited company, it is pretty easy to still maintain the amount of shares you had, the amount of control you had before, by having the amount of shares you had, like the share percentage you have before. So example, if you were a partnership before and you had 50% stake of the company, now you can pretty much convert it into shares and you have 50% of the shares. Also, it's able to raise capital from sale of shares to family, friends, and employees, which is a really good thing to finance your business or investments. And it's a greater status than an unincorporated business. Just to be clear, an unincorporated business is the sole trader business and the partnerships, and incorporated business are the limited companies. Now, the disadvantages to a private limited company is that the legal formalities involved in establishing the business. That means there are so many legal things that have to be done. It takes a lot of time and a lot of effort to convert to a private limited company. Also, the capital cannot be raised by a sale of shares to the general public because it's like I said, private, so there needs to be a lot of contracts and legal talks again to sell a share to someone. Yeah, the third drawback is also it's difficult for shareholders to sell shares. As talked before, there's a lot of legals going into this, and also all the shareholders in the company can pretty much decide a bit if someone of the company is allowed to even sell his shares or her shares. And also in the private limited company, you also there are end of year accounts which must be sent to company's house. In the UK, it's kind of like the financial institution that oversees all the financial documents of the limited companies. And these accounts are also also available for public inspection, meaning there's less secrecy over the financials of the business than it is in the sole trader or partnership. Now, public limited company, the benefits of it is again limited liability and the separate legal identity thing. And the same is with continuity. So it's a lot of similar points like in the private limited company. But then they have another benefit that is it's the ease of buying and selling of shares for shareholders. And this encourages investment in public limited companies because people can just easily, without a lot of contract talks, go into the markets and buy these shares. And they can also sell the shares, which makes it even more favorable to look at as an investment because it's more liquid. People can go faster out, so it looks better and safer for some people to invest in. Also, it has access to substantial capital sources due to the ability to issue a prospectus to the public and to offer shares for sale. A prospectus is kind of a legal document describing the security or the share that is sold on the market. Disadvantages are, like before, legal formalities, information, also cost of business consultants and financial advisors when creating public limited companies. There are so many rules for public limited companies, so many rules and guidelines and so on, that it will pretty much cost a whole new department to let them figure out all these rules and to make the business conform with all these rules, which is very costly and time wasting a bit. Also, the share price is subject to fluctuation, and it's sometimes for reasons beyond business control. For example, the state of the economy or a market crash, as you could see in the Corona crash last year. Also, the legal requirements concerning disclosure of information to shareholders and the public, example giving annual publication of detailed reports and accounts. It's a bit similar than with a private limited company, but in the public limited company, you have to publicize way more content and way more financials to the public than with a private limited company. So it makes it more difficult. It takes more time away and is more costly, and you absolutely do not have secrecy with your financials pretty much. Sorry for that. Also, there's a risk of a takeover or a hostile takeover due to the availability of the shares on the stock exchange, because anyone in the public can pretty much buy it. Also, often the directors of a business or the managers are influenced by short-term objectives or short-termism of major investors, like major shareholders, because they are always pushing for this extra profit in the short term. All these Wall Street analysts are Wall Street people, Wall Street businessmen are known to be very short-term oriented and asking for the business to perform in the next quarter only. So thank you for watching. My part two for this video or for this unit will include way more about the cooperatives, also the microfinance providers, PPPs or public-private partnerships, and about non-profit organizations and non-government organizations. Thank you for watching again, and I'll see you in my next video.